Hello, good day, everybody. We are starting our webinar on understanding the financials. I am very pleased to have with us here today Joe Clarke, who is the aficionado when it comes to all things in understanding your business plan. We talk quite a bit about the importance of business planning and why you should have one. And one of the pieces that we hear back quite a bit from our clients is, well, what are the financials? How do I come up with the number that I need? How do I understand the pricing? And so I've worked with Joe for many, many moons, many, many years, and understanding exactly how you come up with those numbers is really, really important. So with that, I'm going to jump in. We saw this scene before, which shows your plan and all the things that go into it, from your market research, from understanding your target market, making sure that you have the employees that you need as part of your team. And there's a myriad of things that you need to do. And I think the one thing that's missing on this slide is the financials, and I think it's the most important part. How we're going to enjoy today's webinar is this. Right now, everybody is in listen-only mode. However, you can ask a question at any time, and we have a period towards the end where you can ask questions. For those that have joined us on Facebook Live, do the same thing. Chat us your questions on Facebook Live, and we'll be sure to answer them either in the webinar or right shortly afterwards, so you have your questions answered. We will be providing the materials on our webpage by Friday, so you'll be able to relive this presentation either in webinar form or on Facebook Live, so that you'll have the information indefinitely as you go forward in building your business and living your dream and having all the tools that you need in order to succeed. If you do have a question, don't forget, just type it in the chat box, and my good friend Janine Finch will be moderating the session for us. Last week we had some amazing questions. We had some really, really good questions, so we were looking to hear from you all. Like I said, follow us on Facebook. We are live streaming in stereophonic sound. So definitely please join us, and we'll also be using our hashtag BizLaunchChat. And just a little bit about Joe. I said earlier that he's amazing. He is a mentor here with us here on Tuesdays. Right. So today is your mentor day from 9 to about 3. We take appointments. Yep. Feel free to call us at the number that you see, 703-228-0808, and you can set up as many appointments as you need with Joe to help you as you're walking through this process, or if you have questions later on as you dig in deep. But Joe, of course, has over 40 years of government consulting, as well as in the commercial and the government sector. Joe, did you want to say some words about yourself?
Well, basically, first thing I mentioned to everybody is I'm not an accountant. So I don't have any certifications or qualifications to talk about what I'm going to be talking about. However, I do have years of experience of reading and using financial statements to make business decisions. And that's really the main focus of this. How do you make sense of these documents that you get from your accountant or you produce yourself, and then use those to make informed decisions to move your business forward? That's
right. And what I like about Joe and his expertise and background is just the way you present that information in a really clear, a novice can become a professional.
Absolutely. Absolutely.
Which I love. So definitely stay in touch with us. And this is just a real quick agenda. We're going to be talking about the context of business planning, financial statements, what is your break-even point, or when do you know that you've broken even? What are financial projections? And that's like looking into your crystal ball, but in a very strategic way to make sure that those numbers make sense. And then, like I said before, we're going to have a very dynamic Q&A session. It's just not going to be Joe telling you what to do, but if you have questions as we move ahead. And with that, I hand it over to my comrade in arms on What are we doing? Strategic business planning.
Planning how to have a profitable business.
And I love that.
Main issue.
That sounds awesome.
And as we were talking about that, people tend to enter this subject matter with a huge fear factor. And you get people as the deer in the headlights look. You say, show me your financial statement or tell me what your profitability is, and they're looking at you as if, I knew I was going to be asked this question and I'm not ready for it. So what we want to talk about is eliminating that fear factor and understanding how those numbers can help you make important decisions. As Tara mentioned earlier, what we plan to talk about are just put it in the context of what the business plan itself is. What are the financial statements that you need to be concerned about, and what do they really mean? And then get into some really practical things that you want to understand before you get your business up and running, such as, what is my break-even point? What's the point at which I start making a profit? And then financial projections, we'll talk about how we put those all together, but also make you aware of a tool that SCORE has developed that basically is a spreadsheet, an Excel spreadsheet that lets you plug in some numbers, and then it will produce the financial statements that you need for you. So take that fear factor out of the way right from the very beginning. All right, so going into this, let me just set the context. We talked about this last week, and it's worthwhile repeating this one concept on this one slide because it sets the stage for everything that we're doing. The one that we handled last week was the process of business planning. We started off with the idea of defining a product. That product then is sold to an identified market. You're doing that knowing that there's other competition out there offering different or similar products. Based on that information, you decide a marketing plan, what you're going to do to tell the world about your better product and why they should buy from you. As you do that, you create a sales projection that says, here's my target of what I want to do, how much business I want to do, by when. Given that sales projection, you can then do all of the mechanics of laying out your business and the planning for your business. You can set up your operations. You can define what type of organization is going to be needed to execute on this. You establish what resources you're going to need, and then from there you can analyze the finances. As we mentioned last week, this is an iterative process. The first time you go through that, things are not going to work out. So you've got to know either you're going to be operating at a loss or else you're going to be at such a profit that you can never get all the resources that you need to execute on this. Given that, you come back in and modify your projection, redefine your product, look at that market, and then you keep iterating through this flow until you get to the point where something makes sense to you. That's what we lock in. That's where we get all of the things that we need to understand for our business, our value proposition, how we're going to market it, what type of projection we're going to use. And then the part that we're going to focus on today is over on the left. We're talking about your financial statements. And there are a number of financial statements that are standard that you need to have for every business. I want to go through those and help you understand what those are. And then we'll talk about how do you make use of that information to make some informed decisions. All right, so the financial statements. If I'm starting a business, I'm going to look at that, and I've got a couple of questions. I want to know how much do I have to put in? What do I have to invest in this business in order to get it started and have it be effective? And then I want to know, as I run this business, is it going to be profitable? Am I going to be able to sell my products for more than it costs me to manufacture or to even deliver the services that I'm talking about? Now, that may not be profitable on day one. It may be a little bit further down the road that I finally get enough sales to become profitable. I need to understand when that point will hit. Third question that I want to know, given that situation. I want to know how much cash do I have to have on hand to be able to handle the cash flow. Do I have more money? Do I have to put out money up front with the expectation that I'm going to receive sales? So what I want to know is how much of a drain on my cash reserves is that going to create? And this is especially true if you're going to be operating at a loss until the business builds enough momentum to become profitable. That negative cash flow has to be understood. So we have in accounting systems, there are 3 statements that will give you that information. The questions we want to answer is, how much do I have to invest in this business? Is it going to be profitable? And what is my cash flow? Those are the 3 statements that I want to present to you. And these are the 3 that every business plan gatekeeper is going to say, show me your finances. These are the 3 statements that they're referring to. All right, first one, balance sheet. Balance sheet says, okay, how many assets, what are the things that I own, OWN, and what are my liabilities, which are the things that I owe, OWE. And obviously, if you take what you have as assets and you subtract the liabilities from that, hopefully there's a positive amount that's left, a positive number, and that's the net worth of the business. So that's the balance sheet tells you for that particular point in time, a singular point in time, what is the net value of that business? How much does it have in assets? What liabilities do you have? And what's left over? So given that, I can then say from a accounting point of view, here's what this business is worth on that point in time. Now we use the term here, accrual, I can't even talk today, say accrual basis as saying versus, there are 2 ways of accounting for transactions. I can either do the actual part that says, here's how much this transaction is worth and when is it going to happen. It may not be happening for a few months, but I know about it and I'm obligated to do it. I then record it in my system. There is another form of accounting that is the cash basis. And that one, what we're talking about, is until the money changes hands, the transaction doesn't even exist. 2 different historical reasons on why these systems were developed. It suffices to say that as you grow on your business and as you become more sophisticated, if you will, or more advanced in how you're accounting for things, most companies, if they start out on a cash basis, will migrate to an accrual basis. So that's just something to be aware of as we go through. The balance sheet is done on the accrual basis. The main parts, given the definition of what we say is the net worth of the business, the main parts of this statement are the assets, the liabilities, and the owner's equity. Now, the other terminology to throw at you, I'm just hitting you with some of the definitions that the accounting industry uses. We'll talk about current and fixed, such as assets are either current or fixed assets. Current, by definition, are those things that are designed to be used in the next 12 months. So if I've got something, an asset that I buy, say inventory stock for my product that I'm developing, that's a current asset. Something I bought it, I'm planning to use it in the next 12 months. Things that are for a longer term, things like a car that the company owns or a piece of equipment, will be for a longer period of time, and those are known as fixed assets. Even if they're mobile, they're still a fixed asset because that's something that's designed for a longer term period. Liabilities can also be called short-term or current liabilities, and those are those bills that you have to pay in the next 12 months, or they could be a longer-term liability. All right? So let me go on. That's sort of a quick snapshot of what I mean by a balance sheet. The income statement, the second statement that you're looking for, is the one that says, are you going to be profitable? This is also called the profit loss statement. What you're looking for there is I want to know how much income have I generated, typically by sales, and then from that, what are the expenses that I've had in producing that revenue? It will be covering a period of time as opposed to a particular point in time. So it's going to be for quarter one, or it's going to be for the full year. It's going to cover a period of time that you're measuring all of your revenue that you're generating as well as the expenses that you incur to get that revenue. The main components on this are going to be revenues, which are funds that are generated by selling product or service. The cost of goods, this is a key item that I want to just focus on for a moment. The cost of goods, also called your variable costs, are those costs that you have to pay in order to make the deal to get the product. So I might be replacing inventory, or I might be buying ingredients for a meal that I'm making, or I might have to pay some travel costs for a consulting hour that I'm doing. These are things, these are costs I'm not going to pay unless I'm making the deal. I make the sale, and then I incur costs that are directly associated with that sale. Now, typically, those are all paid right out to somebody else. So what you do is you take your revenue and you got to pay these cost of goods sold right up front. And that's a critical item for you to understand. You'll see it as we go forward in this discussion where it plays a very vital role. Next thing then is I've got all the expenses I have in operating my business. Those are going to be things like the salaries I pay people. It's going to be my office expense, my rent, my insurance, all those costs that are fixed and predetermined that I have to pay regardless of the number of sales that I make. Then I have a thing called depreciating. Depreciating costs or depreciation. The IRS says those fixed assets that we talked about earlier, you're allowed to replace them over time. So the IRS says you can take a business deduction to put money aside to replace those assets. So if I buy a car for the business, and that's going to last a certain number of years, the IRS will tell you how long that has to be, and then you can then set aside money each year to replace that after the useful life is finished. Doesn't mean you're actually going to put it in a separate account. Doesn't mean you're actually even going to spend that depreciation. You may not replace that asset. You may continue it after it's been fully depreciated. But the point is that you're given an operating expense that the IRS allows you to use to offset the replacement of that asset. Then we got interest expenses. These are if I take out a loan, I'm paying not only the principal to repay that loan, but I'm paying interest or the cost the bank is charging me for having that loan. That is a legitimate business expense, and that goes on this statement. Then finally, the income taxes that the business pays, as opposed to you, the individual. This is what the business is paying taxes, and that goes on this statement. If I put that all together, what happens is you take your revenues, you subtract out your cost of goods sold. That gives us something that they call the gross profit or gross margin. That's an extremely important number because what you'll find is most businesses will all have about, if they're in the same industry type, they will have the same gross margin. And you want to know what that gross margin is for your industry type and how close are you to that. So, for example, when you go and eat in a restaurant, if you buy $10 for your lunch, then typically about $33 of that $10 is going toward their cost of goods sold. $7 that's left over is used to operate and run the whole business. That's an important number. Next one out, you take out your operating expenses and you take out your depreciation. What's left is the operating profit. That tells you how efficient is the operation of your business. How well have you got your processes in place, got people doing things. That's an important aspect of telling you the internal operation of the business. From there, we look at the way that you finance things. That tells us for things like interest or the taxes that you're paying. You pull those out, and what's left over is the net income or net profit. That's the bottom line. That's the number that people are concerned about when they try to decide, is this a profitable business? You know, my sales after all my expenses producing a positive number. That's what we're looking for. Okay? Now, last one is a cash flow statement. What this is telling me is how much money am I got coming in, either through sales or from investments. That if I put some reserves of money into buying a CD, I get money from that. Or if I take out a loan, I get an inflow of cash because the bank grants my loan, and now I'm ready to go with that and I can use that. So there are different ways that you may get money in. And then what you're looking for are how are you using that money, how much of that money is going out. And this you're typically looking at month by month to see where am I going and do I get to the point where I have a negative cash flow. If I have negative cash flow, I've got to pay that I got to pay that somehow. I may take out a line of credit or I may have to dip into my cash reserve, but one way or another, that negative cash flow has to be paid. All right, so those three statements basically are giving us that snapshot on how much money do I need to invest in the business, is it going to be profitable, and what's the impact on my cash levels as I operate the business. That sort of just gives us the basic information that we use, and what we do with that now is we make some analysis and decide what to do about this business. That gets us into the pulling this all together. I'm sorry, I forgot I have one more slide. I want to pull this all together. I take my balance sheet, which then tells me what are my assets and my liabilities. I'm assuming that you have, if you look on over on the right on the bottom, we have the owner's equity. We're assuming positive owner's equity, so that would then be the liabilities and the equity should total to the same number as the value of my assets. And that's an important part. That's when when the statement balances, this is what we mean. Everything, numerically, the numbers agree. Doesn't say great, bad, or wonderful business, just says the numbers agree. We modify that balance sheet statement by operation of my business. When I'm actually selling things and paying expenses, from there I've got some net income left. Now, what you can look at this, where is that net profit going? Where is that moving to? Or how does this all work together? And we start to see the interaction between these different statements. So my net profit basically goes into owner's equity. If I'm depreciating my assets, that goes in as an operating expense. So we're starting to see these two statements having connections between them. When I bring in the cash flow statement, again, my cash flow could be either from investments, my operations, or my financing. And I look at the interactions there. When I buy or sell assets, that impacts my cash flow. When I operate my business, it impacts my cash flow. When I take out financing and come out with a new loan or pay off a loan, it impacts my cash flow. All of which goes back up into the current asset, which is part of my cash level, is part of my current assets. Two takeaways from this that are really important aspects of this. The first is you need to have all three statements that say what's going on with the business. You can't tell how good or bad a business is doing with one statement only. The second takeaway is that there's a lot of interaction on these. So what happens in your income statement is going to have an impact on your balance sheet. It's also going to have an impact on your cash flow. So look for those interactions as you're reviewing things and you're looking at different items. You should understand that if I change my profitability, if I change the price I'm selling things for, what is that going to do to my cash flow? How is that going to impact my balance sheet? That's the point I'm making, that these are all interrelated and you need all three statements to say what's happening to that business. All right, now I'll go on to the next part. How do I make decisions based on that? Now, you've seen some of the statements. You understand what the terminology is. Let me hit a little bit more terminology and then I'll give you an example of how to use that to make an important analysis for your business. Definition is I want every expense that I have in a business can be put into one of two categories. It could either be a fixed expense. That's a predetermined expense that I know I'm going to have, and I put it out, and it doesn't matter what happens to my sales volume, I still got to pay this. So I got to pay my people. I've got to pay my rent. I've got to pay my insurance. I've got to pay any of the marketing that I'm doing. All of these expenses are things I'm putting out there, and I've got to pay regardless of the level of sales. Now, obviously, if sales are really going high and I hire more people, then my fixed expenses will go up a little bit. But in general, what I'm talking about is these are not related to or driven only by the sales level. These are fixed expenses for what we expect our operation to be like. The variable expenses, also called the cost of goods sold, well, those things I only have to incur that cost if I make a sale. So if I'm replacing my inventory because I made a sale, that would be a cost of goods sold. If I am paying a credit card swipe fee because the customer bought with a credit card, that's the cost of goods sold. If I hire, it's a little, to give you the full flavor of this, if I'm a consulting firm and I hire a subject matter expert or a stringer and I use them only for that project, they're an independent contractor, they're a cost of goods sold. So there's a lot of things that could fit into that category, but the key determination is, am I only doing it because of this one sale versus something I'm setting up for my business? Now, why I'm emphasizing this and why this is critical is in this next part, which is the break-even analysis. And a break-even analysis says, what level of sales do I have to get to so that all my fixed and variable costs are covered? That's the definition of the break-even point. And it's critical because that's when the company starts to make profit. Before that, they're operating at a loss. Okay? Now, there is a formula they can use for this. We also have it built into the tools that we will distribute. But basically what you're saying is I take my fixed costs, and what I'm going to divide it by is something called 1 minus the variable expenses, which are expressed as a percentage of sales. If you think about it, the sales minus the variable expenses or cost of goods sold is my gross margin. So I can replace that whole bottom part, the denominator, with just a gross margin. So if I'm operating at a 70% gross margin, then I take my fixed cost and I divide it by my gross margin, and that's going to tell me the level of sales I have to do in order to break even. And I can probably sense over the wires here, people's eyes glazing. Through a formula at them, and people talk about ratios, and they say, not going to handle that. So let's walk through an example of this. We'll just visualize this. Here I have my sales and revenue on the left, and the number of units that I'm selling along the bottom. All right? Now, I can throw out some lines here that should make some sense. For example, a flat line that doesn't vary according to the number of sales sold or number of units sold would be my fixed cost. So by definition, I got to pay those regardless of how many sales I make. My variable costs go up. As I sell more, my variable costs go up. The total of those are the total cost for me to sell that amount of product or service. Now, I can't go in this and say, oh, well, you're my first customer. I'm really thrilled to have you as a customer. But because you're my first customer, you have to pay all my fixed costs first, and then we'll do a variable cost on top of that. You're not going to make that first sale to begin with. So what we do is we have to look ahead and project what is going to be a unit price that we sell at so that we can get to the proper break-even profitability. So we take our sales, we determine a unit price for that, and then as we sell those, you can see that dotted line gives us the sales volume. This is the critical point. where the two intersect, where your sales numbers intersect with your total cost, is the point that we're looking for, because at that point, all my costs are now been paid. Before I get to that point, I'm operating at a loss. After, I'm operating at a profit. And that's why this is such a key point, a key analysis that you want to do as you're looking at a business. How much sales do you have to get to before you are profitable? And just to be clear, loss, bad, profit, good. That's what we're aiming with this whole thing. Okay. Let's give an example. I'm running a consulting shop. My rent is $2,000 a month. My staff salary is $8,000 a month. If those are my only costs, then my total fixed costs are $10,000 a month. If I'm selling things, let's say I'm doing assessments of products that were environmental assessments, and I have a unit price, I charge the customer $300 for that. I've got to do lab tests and the rest of that. That costs me $100. That's my cost of goods sold. If I crank in those numbers, where 100 is 1/3 of the price, or 0.33 of the sales price, do the math, it says that I have to do $15,000 of business every month in order to break even. And if my unit of work is $300, then that means I have to do 50 of them. So basically what we're finding out here is the level of effort that we've got to go through in order to reach profitability. Putting that together as a graph, we can see where our $10,000 is our fixed cost, $15,000 is our break-even point, and that's 50 units. Now, this was a simplistic example of this, but this is a key factor that you need to understand as you're analyzing your business or even operating your business. You want to know how much of this work I've got to do in order to be profitable. You can do your break-even analysis on a year basis or a month-by-month basis or even every week. You might say, for example, tell your staff, if we do $10,000 in sales this week in my retail store, pizza's on me. I come in, everybody, we're going to celebrate that. What you're doing is you're giving people a tangible goal to go after, and that's critical. You want everybody working toward the goals that you have. If that $10,000 in sales represents a break-even point per week, then get everybody moving to the point where you're going to be profitable. So this is how you use this stuff. You build it into the DNA of your operation. Okay. Now, I've thrown a lot of numbers around, and I've thrown a lot of terminology, and the thing I want you to be aware of is that there are tools available that we have that can help you walk through all of this. And basically what we have available for you is a Excel spreadsheet that will walk you through filling out numbers for what do I need for investment, for assets, and what type of liabilities will I take on up front, the upfront costs before I even open up the doors for business. Then I'm going to have staff costs, and we'll help you figure out on an hourly basis, hourly rate basis, how many hours, how many staff, what are all of the fringe benefits that are associated with that. We'll do that calculation for you. So you can pay the FICA, Social Security, Medicare, any unemployment tax. All those things can be built into your fringe benefits. We give you a way of pulling out your unit of sale, what the variable cost of goods sold are for that, and then doing a sales projection month by month and laying that out for 3 years so that you can calculate what your sales revenue will be. We do a tab on this spreadsheet that will then do the fixed operating expenses. How much is your rent? How much is your marketing cost, advertisement? What are the things that you're doing that are going to have these fixed costs? We can put a budget together for that. Given that information, the spreadsheet will crank all of that. The first thing it will do is it will do a break-even analysis for you. More importantly, then it will produce the cash flow, the income, and the balance sheet statements for 3 years out. So you have all of that available to you. The next thing we'll do is one thing we didn't hit in this presentation was we have a thing called benchmarks or financial ratios to review. We'll calculate many of them, and you can compare yourself to others in your industry. Then finally, what we give on this spreadsheet is a diagnostic, which will walk through, given your model, we'll look at some of the normal rules of operation to say things like, do you have enough for advertising? Are you paying yourself enough as the owner? Is it realistic for your operation? Do you have numbers in there that really represent what we typically see people experiencing? Given that, we can give you feedback on your model even without coming in and talking to anybody. Now, in support of that, we also have a how-to guide. It's basically about a 50-page PDF document that walks you through step-by-step, filling out the spreadsheet, identifying, giving definitions of what do we mean by each of these terms. So that with that, you can actually sit down and create the financial model. What I find is critical, especially from a business plan point of view, is get the numbers first. Understand what your numbers are, what is that point, that model, that level of effort that you're planning to do that you feel you can accomplish. Given that, you now have very specific things. You know how many customers you need. You know what level of sales you need. You know what, you can make the decisions on what level of marketing I want to do. All of those things become doable because I now have some numbers as opposed to this general platitude. I want to go in business, sell a lot, and make a lot. That doesn't really help you give a very specific business plan. The other aspect on this is that putting things in a model like this is cheap to save a copy of the model. All right, save a copy of the spreadsheet, make a different spreadsheet for each of the scenarios that you're planning to say, okay, what is my most pessimistic view of this? And if I come out where I'm making a profit and cash flow is not negative, that may make me sleep pretty well at night. Or if I say, what are my optimistic view of this, to see what type of resources I might have to get lined up if my sales really take off. I can answer many of these questions because I use these different versions of the spreadsheet to do the analysis. If I'm shopping for a location, I can have a spreadsheet laid out for each location because my cost or lease will be different, but probably my sales volume might be different based on each location you're considering. Now I can do alternatives of these different options and make an analysis to see which one makes the most business sense. So use the tool to lay out things and to do the analysis of alternatives, but also to do contingency planning. If this happens, what's the impact on me? And I'm ready to then use that to take action. So the bottom line on all of this is the tools available to help you. We are available to help you explain and walk through this analysis for you, or with you, and help be another set of eyes to help review this and get you through this. So the fear factor should be eliminated, or at least minimized, if nothing else. And hopefully we can help everybody move forward.
Now, Joe, quick question before you move. If you go to score.org/start your business, you'll be able to find the template and the guide?
Yes, the guide, the templates there, plus there's all the handouts on there. There's a workshop series that we have for starting your own business, and all those handouts are in there. So you want to go to session 4, which is the finances, and it'll be on there.
And you'll see both the template and the guide for that.
Right, as well as a case study that shows how it was used.
Okay, great. That's very helpful.
Sure. All right, I think that was basically what we wanted to cover on this part of stuff today, and I'm going to turn things back over.
Great. Now, what we're going to do is I know that we have a lot of questions, so I am going to go to our friend Janine Finch, who will be I saw that there were people raising their hand as we were going along, Janine, so just wanted to check in with you.
Hey, yeah, great job, guys. So we do have a question about consulting work. The question is, if I'm a consultant, excuse me, I can't talk either, Joe. If I'm consultant charging by hour of work or some by lump sum for delivering a report or workshop, how do I calculate the unit price? I'm presuming that this calculation will help me decide what is my hourly rate and the number of hours of work I need to lock in order to be profitable. Or should I see the market rate and then figure out the number of units I need to lock in to be profitable?
Yeah, and the answer to that is both, and I don't mean that facetiously. You want to look at what the market rate is and decide, given what other people are, whether you're looking at the GSA schedule rates for a labor category, however you're determining that, you want to find out what the market's opinion is for that work that you're doing. Mm. That's an important input, but it's not the only input for what you're doing. The question that really comes down to this is, well, it's twofold. One is, what are your costs in doing that? So you've got to look at all your fixed costs. You've got to look at your the hours, all of the direct labor costs that you're going to have. All those things are a part of that analysis of what is the cost for you to deliver, to go from a direct labor rate to a fully burdened rate, to say whether or not you're going to be able to execute on that. So hopefully that cost is lower than what the market is charging for that. The second aspect on this, though, is you've got to decide, are you a commodity or are you a niche? Mm. And if you're a commodity, then you better be at or below the market rate. Because a commodity, there's no differentiation between you and everybody else that can do this, and therefore you are basically competing on price. If you, on the other hand, you're a niche, you're highly specialized, you've got some knowledge or a subject matter expert, and you're somebody with either certifications or reputation within the industry that says, hey, this is the person to turn to for this, then you should be charging at a niche price, which is going to be substantially higher than the market rate. And you need to understand all those things as you market yourself. If you market yourself wrong, if you put the wrong price, you telegraph to the market what you are. I retired when we were charging hundreds of dollars an hour for my work, and I had the same knowledge. I decided I'd start a business.
Go off on your own?
Yeah, but when I retired, and I said, what the heck, I don't want cost to be a price, so I slashed the price. Big mistake, because that telegraphed to everybody that instead of being able to do strategic analysis what I was doing, I'm now only capable of doing tactical work.
Oh, wow.
And therefore, I was not considered by people for a number of opportunities that really should have applied.
Because you had
I sent the message out that I'm a commodity as opposed to being a niche.
A niche.
Yeah.
And I think a lot of times with the clients that we're meeting and we're speaking with, that they don't want to have the price too high.
Right.
Because they don't want to then take themselves out of the competition. How do you address that?
Well, I mean, and that's why typically people who start up undervalue themselves. They telegraph to the market that what they are selling is not really worth that. And it's tough.
Yeah.
I'm not
the chicken
minimizing
or egg, you know,
because you want business, you want to get started, and you feel like I got to get going on this. And certainly that's important to build that track record. But if you aren't careful, if you don't do it properly, you're going to be underselling the value because you get locked in at that rate. Whatever rate you pick, that's what people know you at. And you can't say, well, now we're finished with the introductory, now I'm twice that rate.
I'm going to go up 100%.
So there may be things that you have to do in order to break in. You might need to do things where you do more on a firm fixed price for a unit of work. At that point, your hourly rate is not exposed. So I might do work that may take me longer to do until I learn and get comfortable with it, but I'll do it at a firm fixed price so that I can then establish the value to the customer for what I'm doing and divorce that from how long it takes me to do that.
Makes sense.
As I get started, I might want to have the majority of my work being done as firm fixed price jobs. Now that also plays in the other part of the labor rate is in my world, if you were a subcontractor bidding with a prime, that prime's locked in on what labor rates they're willing to go, and you're locked in no matter whether you think you're a niche or not. This is the rate that they're going to be able to pay, and you get locked in with that. So then you've got to think of shifting. How much of this can I shift to a firm fixed price to get away from the labor rate lock-in?
Wow. Janine, any more questions?
Nope, not from the webinar. I don't know if there's any on Facebook.
Well, I have a whole bunch. And so maybe as we're going along, if anybody from the webinar has or from Facebook has additional questions. But Joe, for me, that's the question, going back to the last question answered, is the pricing.
Right.
And making sure, because I really feel like that's the one piece where people feel uncomfortable and knowing what their worth is.
Right.
Because many times, too, people have the hobby, and now I'm going to make this a thing.
Right.
And then, but the thing is me, and I love doing it, so I'm not going to charge. I mean, this is, to me, where you have to kind of know your worth, and how do you cut through? How do you cut through that?
Yeah, exactly. And that's a tough one emotionally, it's a tough one for people to answer. Intellectually, it's very straightforward. It's certainly easy for me to say, don't do that. But when you're there, you're uncertain on whether this is all going to work and people value you the same as you do, then you're going to be motivated to say, I'm going to slash my price.
Yeah.
But you've got to think, again, from the customer's point of view, much more important. Here's what I'm struggling to articulate. The customer sees value in what you're offering, and they will buy as long as the price is below what they see as the perceived value. They are looking for people who are going to offer something that's close to their perceived value but below it. Now, if you go in and you come in too far below, then they're saying this person doesn't really understand what it is that I am trying to buy. And you will have a negative impact by pricing your product or service too low. And that will happen more times than not.
Okay.
You need to do the analysis not from how much it costs you, but more importantly, what is the value to the customer?
The perception.
You have to get inside their head and understand that. And that's difficult, especially until you get going.
Yeah,
and
as you're starting out.
Right. And what you may do is do that analysis, think about, you're doing focus groups, you're talking to a bunch of people, you're searching the web to find out what people are selling the same service or product for, and getting on a better assessment of what the market value is. That's the starting point only. And you have to position yourself according to what an objective analysis of what value are you offering.
Okay.
Now, you may pick your price and then offer a special discount or introductory offer, or whatever you want to call it, that is lower than that in order to get the process flowing.
Now then, my leads me to this. Like, say you're going along and you have a particular price, and you're at that price point, and then you realize that that price point is wrong. How do you then readjust in such a way where it makes sense so that you're at the break even and that, because what if it goes along that your price is off? what?
Well, let's talk about two different scenarios. One is where your price is too high.
Yes.
Then you may offer special sales, special discounts, special promotions that then become your normal price.
Okay.
So you can work your way, you can step your price down, and that's a relatively easy thing to do compared to raising your price.
Price up. Okay, got you.
Raising the price, and you've got to convince the customer of the extra value that they're receiving. Now, either your price is wrong and needs to be higher because you are providing more features or value than the market, and the customer just didn't realize that, and that's why they're looking at that lower price. So maybe you introduce new capabilities, or you may take what's already there and emphasize that as a new feature.
Got you.
Something that justifies that price increase.
Okay.
Alternatively, you can do like the cable TV plan, the basic rate, and adding all of these additional items that can raise the effective average price higher.
I think Netflix does a good job. Like, they started off at this really, like, great price.
Right.
And then it'll be a year or two goes by, and they're like, hey, we're adding inventory, we're doing this. And you feel like you're getting such a good deal, you know, as you go along. I don't see people saying, well, I'm going to get rid of that.
Yeah.
You know,
and
from a psychological.
Well, that's it. I mean, it's all a matter of managing the perception. How do I change the perception of what I'm receiving to justify a different price point? And that's
and educating your customers too.
It could be.
I think.
It could, well,
as you go along, step by step.
Yeah.
And letting them know.
And that's why I think most people take the cop out. If they're not getting the sales, they drop the price, because that's easier than trying to redefine and market yourself or convince the customer or educate the customer on all the value that they're getting. They take the easy way out.
Yeah.
When really what you need to do is refine your marketing message to emphasize the value that you're producing.
And I think looking at when we talk about higher prices and value, I also think of like Apple and their various products that they have.
Right.
Those price points are pretty high.
Right.
And I was wondering, you know, the market all the time was about giving people, oh, you could buy a cell phone for a penny. And, you know, all you have to do is sign up for this 2-year plan.
Right.
And then there's been this move, this whole shift where, okay, we're not doing that anymore. Now you have to buy the phone, but we're going to put it into the contract. And that's a major shift.
It is.
But people are doing it.
Look at the things that happened with that. And that's an interesting illustration of this, is that, number one, it's not a commodity. Because they have, through their design, a big part of it is the design that they work, but in addition to the features that they keep introducing, they've done things that make it unique and stand out and not directly comparable or undifferentiated from the competition.
Got it. Okay.
By doing that, they're justifying them being a niche versus a commodity. And that allows them, and as they're leading the marketing, or in some cases, getting back up to the market, so there's pros and cons in what they do, but depending upon how they're moving things, if they're defining the market, that's going to be at a higher price. And
I think that's a good example of like pricing and making sure and understanding. You know, your worth and your value.
Right.
So, Janine, I'm going to check in one more time to see if we have any questions.
No extra questions over on this end.
Okay, great. Well, I want to thank you, Joe,
my pleasure,
for everything. This has been great. We will have the PowerPoint and all the materials. I'll make sure to also send out the link where you can get the resources, because I think that's really an amazing value to have.
And I just, if I could, sort of a parting note on that is the tools are great. The tools do a lot and help you get past a lot of the fear factor. So definitely use the tools, but the tools by themselves aren't the answer.
That's right.
You need to be doing this in conjunction with a mentor, somebody who can walk you through this and say, okay, you understand what this term is and what we're looking for here, But now, how do you put that together? How do you think about that in the overall picture? And I don't feel like, you got to get an appointment with me. We've got a whole bunch of score counselors that are very comfortable with the tools and very comfortable with building your financial model and helping you move forward with that. So it's a lot of people with a lot of experience.
And I think that makes the difference.
It does.
If you can kick in with somebody to be able to check in, is this feasible? How does this number look? It's much better than being an island unto yourself.
Absolutely. Yeah. And I think what happens is if you come in with very general ideas or general concepts, it's very difficult to give you concrete, specific help to moving forward.
Yes, yes.
If you've done at least a first cut and you've looked at these things, then we have something we can discuss and
kind of chew on.
And become more succinct in what we're talking, what type of advice that we help you get to.
That's a very good point.
We don't solve your problems for you. We work with you to help you solve your own problems in an effective way.
I love that. Thank you.
Okay.
Thank you. And thank you so much for tuning in with us, Joe and I. I thank him. I thank you for joining us during this lunch hour. We look forward to seeing you again really soon. We have some cool events that are coming up in the next few months. And so thank you all and have an amazing day.